Today, households under the pump as housing costs soar. Hello again, it's Martin North from Digital Finance Analytics, one that is post covering finance and property news. Today, what I want to do is to update you on our modelling. Of course, we model each month the impact of household finances, particularly looking at things like mortgages and rental payments and how that feeds into the overall picture. And well, there's a lot to talk about, really. I guess a good starting point is always to come back to the fact that if you look over the long-term trends, property prices have accelerated consistently above gross disposable income per capita. These are averages, of course, but it shows you just how far away we have gone. And there was an article that really underscored this. Home buyers nationwide need to earn around $161,247, or 41% higher than the average wage, to afford a mortgage and avoid financial stress, as home prices hit a record high, according to Jarden analysis. Now, it must be said that they use the 30% of income as the metric, but they do say that this is a real problem given our expectations that prices are set to rise by 6.1% this year. It's hard to see housing affordability improve without further interest rate cuts. Housing affordability has become, of course, a key election issue, with both major parties outlining some plans, some would say big plans, but their policies focus more heavily on the demand side. And just to go into a bit more detail here, in Sydney, households will need to allocate 57.9% of their average income to service their mortgage. That's the highest in the country. That's a sharp deterioration over the last 5 years, they say. And in fact, Sydney-siders would need an income of around $235,000 to service a mortgage for affordable housing, according to their analysis. Adelaide is the second most unaffordable city at 47.4%. Brisbane follows with 44.8%, Hobart at 40.5%, and Perth at 37%. And surprisingly for some, Melbourne is the most affordable city for home owners. They only need 36.6% of their income to pay for their mortgage. But of course, that would be still above that magical 30%, which people talk about. And for those looking to buy, the scenario has worsened with only 1 out of 5 suburbs nationwide, or a total of 703 suburbs, affordable for a home buyer earning the average income of $114,426. That's according to separate analysis from CoreLogic, now called Cotality. The scenario is even worse in Sydney. Only 2.2% of all suburbs, or a total of 14, are accessible to the medium income household. That would be $121,721 a year. Those include Bankstown, Cabramatta, Fairfield, Gosford, Granville, Harris Park, and Liverpool. In Adelaide, where affordability has worsened rapidly in the past few years, only 1.2% of all suburbs, or a total of 4, are affordable to the median income, making $103,106 a year. An average home buyer in Brisbane can access only 6.3% of all suburbs, or 22, where the mortgage repayments on the property does not exceed 30%, and in Perth, only 1 out of 7 suburbs are within the reach of the average home buyer. That's $128,799 a year, and in Hobart, only 4 suburbs are affordable. So this is more confirmation, if you need it, that things are quite desperate for many households. And frankly, nothing really is going to change, although as we will see, if interest rates do come down, that will help a little. One other factor to bear in mind here, of course, is that we should think also not only of money coming in and going on the mortgage, but more broadly on other outgoings. One of the critical outgoings, of course, is tax. And there was some data that came out that showed that income tax eats up on average about a quarter of Australian wages. And that's the 4th highest imposed in the developed world. That's according to OECD data. Now, it's worth saying, of course, there's been quite a few discussions about tax reform. And we have to be careful because in Australia, we do have compulsory superannuation, which is around 11.5% of gross wages currently, rising to 12% in July. If you add in superannuation, then we're right in the middle of the OECD in terms of the overall tax burden. Of course, you have to compare apples with apples. But the point I want to make is that we have significant pressure on households, particularly because the rising tax take and the burden of taxation. And on an international basis, it's still pretty high. Now, the next thing to look at is the question of will rates be cut? Well, of course, the inflation data that came out showed that we dipped below the 3% range for the first time in 3 years, which sort of opens the door to a rate cut. Approaching the end of a cost of living election, Treasurer Jim Chalmers said the decline in both headline and underlying inflation to inside the RBA's 2 to 3% target was proof of economic progress after inflation peaked at 8% in 2022. And in fact, he said, I don't predict or preempt decisions taken independently by the Reserve Bank, but the market's expecting somewhere between 4 and 5 additional interest rate cuts this year. If that eventuates, that would deliver hundreds of dollars every month to Australians with a mortgage. Now, I have to say that I think is overstating the likely rate cuts. IFM Investors Chief Economist Alex Joyner said there appeared to be enough progress towards the 2.5% midpoint of the RBA's inflation target for the central bank to lower interest rates in May. But he thinks they'll remain cautious and data dependent and suggests a follow-up in July is not guaranteed. And if you look at some of the other data, it's the same sort of story, really. There is some opportunity for rate cuts, but not necessarily as hard or as fast as the markets are actually thinking. And the RBA may also take into account the election campaigns and the promises, because you could argue that there could be some fallout from some of these promises, whoever gets in. And as this article suggests, there would be perhaps some wider economic impacts of the consequences of these policies, which might actually, for example, create a moral hazard for taxpayers relating to defaulting borrowers, or people restructuring their finances to creep in under particular income caps. And actually, there's a political dimension to this which is worth thinking about. Now, when you actually stand back and think about all of this, what it means is we have quite an uncertain environment, even before we think about what Trump may be doing with regard to tariffs. The truth is that the impact of the tariffs is probably limited for Australia directly, but indirectly, the impact via China could be stronger. Now, as I discussed the other day, one factor to bear in mind here is that whilst the inflation data is a little lower, it has been driven lower by the fact that taxpayers are essentially paying for it. We are getting electricity subsidies and Commonwealth rent assistance, etc. But all that comes at higher debt. So the question is, are we being conned a little bit by essentially receiving some benefits, but also having to see debt rise higher later? And the other thing to highlight, as I did yesterday, was that renters are still being thrown under the bus by design. There was almost nothing through the campaigns specifically addressing the pressure of the rental sector, where I think it's most extreme. Another factor to bear in mind as we go into this data is to show that the private credit data for March rose again. It was up 0.5%. And as Westpac said, it's a similar pace from January to February and in line with the average over 2024. Annual growth remains at 6.5%. So let's be clear, 6.5% is higher than inflation and higher than income growth. And looking specifically at the private credit component, housing credit, which is 63% of total private credit, rose by 0.5% up from last month. And looking beyond the one decimal number, actually the pace was virtually unchanged at 0.45%, with both owner-occupier and investor credit exactly the same increase. And Westpac also published some other data, which is quite interesting, showing that the recent rate cut has had a little of an impact on the average minimum mortgage repayment. It dropped very slightly. The average spending per person is still relatively low, but rising slightly compared with last month. And they also show that the average savings balances are somewhat lower amongst younger households and among the tax brackets at the lower range. And also those with a mortgage have a little more than those without a mortgage. Of course, a lot without a mortgage are in the rental sector with lower incomes. And the debt to income ratio is also quite interesting. It shows that as you go older, the debt to income ratio tends to drop. But that's because, of course, a greater proportion have no mortgage. And also looking at the tax bracket, those at the bottom tax bracket are up above 7 times. So turning to house prices, Catality's National Home Value Index recorded a straight month of rises in April. Of course, this is CoreLogic under a new name. With dwelling values up 0.3%, the rise in values added around $2,720 to the median value of an Australian dwelling on average over the month. And you can see here how the movements are consistent, with Brisbane up 1% over the last 3 months, Melbourne up 1%, Sydney up 1%, Adelaide up 0.9%, Hobart up 0.9%, and Perth up 0.7%. And there are some interesting variations across geographies looking at whether they're at peak, like Brisbane, Adelaide, and Perth, or below peak, with Hobart 11% below peak and Canberra 6.4% below peak. We've seen considerable growth over the last few years, although it's worth noting if you go back a bit longer, over 10 years, Darwin has gone nowhere. Looking at the variations between regionals and capitals, you can see there that regional Queensland, regional South Australia, regional Western Australia are all at peak, and regional Northern Territories are down 11.7%. And here is the overall summary. So you can see there that Canberra is 0.4% higher over the month, Darwin 1.1% higher, Hobart 0.9%, Perth 0.4%, Adelaide 0.3%, Brisbane 0.4%, Melbourne 0.2%, and Sydney 0.2%. And turning quickly to rents are still rising, 5.3% in Perth, 5% in Hobart, 4.9% in Adelaide, Darwin 3.5%, Brisbane 3%, Melbourne 1.9%, Sydney 1.9%, and Canberra 0.8%. That's for houses. And for units, 8.5% up in Adelaide, 8.2% up in Perth, 7.3% up in Darwin, 7% in Hobart, 4.3% in Brisbane, 2.4% in Sydney, 2.2% in Melbourne, and 1.6% in Canberra. And you'll see there that quite a few of those percentages are higher than income growth or indeed inflation. Looking at the gross rental yields, there has been a little change, slight move up, but the interesting observation, there are considerable variations, for example, between Sydney, which is at 3.1%, compared with Darwin at 6.6%. But I would also make the point that, of course, gross investment yields don't tell you very much at all. You need to look at the net investment yields because that is the real returning cash flow. The gross investment yields compares the price with the theoretical rental that can be generated from a property. The net investment yields compare the income, like from rents, and the expenditure, things like interest payments and management of the property and repairs and things. And I still see in my surveys around 60% of households who are underwater from a cash flow perspective, which is why more property investors are still selling at the moment. And I think that selling pressure will continue for some time to come yet. The truth is, of course, that property investment is not a particularly good investment. And whilst there are still people who are fixated on it, there are significant numbers who are actually out of the market. And I think that pressure is going to continue for some time. So with that context, let's now look in more detail at my analysis. Just to remind you, what I'm doing here is looking at the results from my household surveys. We roll these surveys each month. We have 52,000 households in the sample at any one time. And this is a telephone survey which we get back and model at the end of each month. We slice and dice the data, and we can look at it through the various lenses, including location and types of household. And we can also make some estimation of what might happen ahead by running some scenarios. And those scenarios effectively allow us to take the mortgage stress data, the price trajectory and history data, the buying and selling intentions, the migration data, the latest economic data, put it into the core market model through our scenarios, and then both at a postcode and a region, and also rolled up to a state and all Australia level, we can then form a view as to what may happen ahead. Oh, and by the way, just as we go into this, I do remind you that we do provide a one-to-one service. If you would like to have a specific conversation with me about a specific postcode, I can go into some detail. This isn't financial advice, but I can look at the data to form a view of what might be happening. We can look at the stress data, the home price and trend data, and form a view of what might be happening ahead based on our modelling. These take about an hour via Zoom or perhaps phone, and there is a cost involved simply because it takes quite a lot of time to do all the research. We're booking 3 to 5 weeks ahead. If you're interested, you can book via the DFA blog. Now, let's move on to the definition of stress. I always say this, but it's really important. There are many definitions of stress out there, from 30% of income, I'm not sure whether it's gross or net, it depends on who you talk with, through to underwriting metrics, but we define stress in cash flow terms, money in, money out. And if households have more outgoings, excluding one-off discretionary items than income, we define them as stressed. If they have got a mortgage, they're in mortgage stress. If renting, then rental stress. Investors with cash flow pressures are identified as stressed investors, and we can aggregate that to look at the overall financial stress in a particular area. We can talk about it in terms of percentage of households and also the count. In many ways, the count is a better measure simply because the latter is perhaps the rule of big numbers. If there are a lot of people in an area with difficulty, then that's more consequential potentially. Now, the RBA some time ago came up with this spectrum of household financial stress model. It's quite useful. It goes from budget pressure at the mild end through to missing payments through to insolvency. I'm measuring stress at that mild end, at budget pressure end. Not everybody with budget pressures ends up missing payments or indeed goes insolvent. And in fact, insolvency rates are pretty low at the moment. But of course, that's partly because the banks have been quite flexible with regard to people under difficulty, extending and pretending, extending the life of the mortgage, moving interest only, etc., etc. Or indeed, people have been selling and getting out because home prices have been rising. So if you're on budget pressure, it doesn't necessarily automatically mean that you go insolvent. And in fact, the journey from budget pressures through to missing payments, through to insolvency, can be a matter of years. So looking at the data for April 2025, this is the summary. We'll start by looking at rental stress. In fact, rental stress eased very slightly. It's back to 75% of households in the rental sector. Last month, it was about 77%. That's a consequence of some pay rises and a slight easing in the rental pressure. But I would highlight the fact that still people in the rental sector in existing tenancy are being confronted with considerably increased rises. Looking at mortgage stress, that's sitting at 50%, 50.1 actually this time around. So it's still at its recent peak. And it's dropped very, very slightly from last month because of the fact that we had a rate cut. Comparing that with February 2020, when it was 32.9% of mortgaged households, you can see that half of the people in the mortgage sector with an owner-occupied mortgage are in some difficulty. Oh, and by the way, the RBA updated their debt-to-income ratio, and you can see there that it's come down. It was at 181 in August 24, and it's come down very slightly. But this is a bit misleading because, of course, it includes all households, whether they have a mortgage or not, and includes small business. And in fact, if you look at those with a mortgage, the debt-to-income ratio is often 6, 7, 8, or 9 times. This is the latest data. This is for April. And the first thing I've done here is to show it by state. I've highlighted in yellow where stress has gone up compared with last month, in blue where it eased back. And you can see there that the ACT numbers are slightly lower in percentage terms for mortgage stress and rental stress, but higher investor stress. overall financial stress a little lower. In New South Wales, a similar story with falls for mortgage stress and rental stress, although rental stress at 82% is still very high. And investor stress at 19.8% was higher, and more than half of households in New South Wales are under financial stress, which means we've got more than 1.5 million households in New South Wales in financial stress. In the Northern Territory, we saw a rise for mortgage stress and rental stress. Investor stress was pretty flat, and about a third of households in the Northern Territory have financial stress. In Queensland, there were falls for mortgage stress, rental stress, investor stress, and 45% of households across Queensland are in financial stress. That's more than 900,000 households. In South Australia, mortgage stress and rental stress eased back, investor stress rose, and 42.2% are in financial stress. That's more than 312,000 households. In Tasmania, we saw a slight easing back, 54.5% in mortgage stress, 70% in rental stress, and 15% in investor stress, giving 41.9% overall, or 95,000 households in Tasmania. In Victoria, there were rises though, rises in mortgage stress, rises in rental stress, rises in investor stress, and a rise in financial stress for 47.2% or 1.2 million households. And in Western Australia, mortgage stress rose 53.8%, but it fell for rental stress, investor stress, and financial stress. And that gives us 481,000 households in financial stress in Western Australia. And looking at the grand totals, 50.1% of households are in mortgage stress. That's more than 1.86 million households. In rental stress, 75% are in rental stress. That's more than 2.3 million households. Investor stress is 17.2%, which is more than 511,000. And overall financial stress at 47.2% means that 4.69 million households out of the 9.92 million households estimated across Australia are in financial flow pressure. We can then look at the latest for the segments. And here you can see I've highlighted the segment with the highest level of mortgage stress, which are young-growing families and first-time buyers at 90%. That's more than 291,000 households in difficulty. The highest rental stress at 85.5% are in the multicultural establishment sector. They're the first-generation migrants with more than 199,000 in difficulty. Stressed investors are highest amongst the exclusive professionals, not least because, of course, they have a higher holding portfolio of investment properties at 29.9%, and that translates to the stressed investors there at 84,000. Now I can then drop down to the next level, and here are the top count of households in mortgage stress at the end of April, and you can see there that postcode 2170 Liverpool with more than 13,000 is the top of the list. Then we have Victorian postcode 3064 at Roxburgh Park and Craigieburn with more than 12,000. Back to Campbelltown 2560 with 11,800. Wanneroo in Western Australia 6065. Then Toowoomba 4350. Camden in New South Wales 2570 with more than 9,700. Narrowon postcode 3805 in Victoria. Then Berwick and Harkaway 3806. Pakenham 3810. And Tarnett and Hoppers Crossing 3029. All, of course, high growth corridors in and around Melbourne. Then we go to Ballarat, the regional postcode 3350. Riverston in New South Wales 2765. Merriwa in Western Australia 6030. And Cranbourne in Victoria 3977. We can also make an estimation of default over the next 12 months. Now that's based on a scenario of where mortgage rates might go. And if we take that into account, the risk of default in terms of the count of households is highest in Cranbourne, 3977, with more than 1,000 risking default over the next 12 months. Mandurah in Western Australia is up there too at 6210, and Hoppers Crossing and Tarnett 3029. followed by Roxburgh Park and Craigieburn 3064. Success in Western Australia 6164, Armidale in Western Australia 6112. And I make the point that these West Australian postcodes are still suffering the results of the previous bout of financial pressure in Western Australia. It takes a few years sometimes for defaults to appear. Then we go to Queensland, Yatala postcode 4207, Derrimont and Point Cook in Victoria 3030, Toowoomba in Queensland 4350, Gosford on the Central Coast 2250, Wanneroo postcode 6065, Coomera in Queensland 4209, and Bundaberg 4670. Looking at rental stress, Melbourne postcode 3000 with more than 14,000 households is at the top of the list. Then Toowoomba 4350, Liverpool 2170, Westmead 2145, Southport in Queensland 4215, Campbelltown 2560, Zetland 2017, Hoppers Crossing and Tarnit 3029, Coomera 4209 in Queensland, Ipswich 4305 in Queensland, Cranbourne 3977 in Victoria, Mount Druitt 2770 in New South Wales, Yatala 4207 in Queensland, Derrimont and Point Cook 303 in Victoria, and Parramatta postcode 2150. Looking at stressed investors, we find that postcode 2065, which includes Crow's Nest and Greenwich and St Leonard's, has the highest count of stressed investors with more than 6,800. Then we go to Maroubra in New South Wales, 2035, Beckenham in Western Australia, 6107, Hornsby, 2077 in New South Wales, then Ferntree Gully, 3156 in Victoria with more than 2,400, Cranbourne, 3977, Toowoomba up in Queensland, 4350, Craignish, 4655, Westmead, New South Wales, 2145, Carnegie in Victoria, 3163, Mandurah in Western Australia, 2610, Paradise Point in Queensland, 4216, Wembley, 6014 in Western Australia, and Raglan in New South Wales, 2795. And overall, the aggregated financial stress metric shows that the postcode with the highest financial stress is Liverpool, 2170, with more than 28,200 households, at 72% of households in the postcode in financial flow pressure. Then Toowoomba, postcode 4350, Campbelltown in New South Wales, 2560, Hoppers Crossing and Tarnit in Victoria, 3029, Roxburgh Park, 3064, Cranbourne, 3977, and Derrimont, 3030, all, of course, those high-growth corridors in Victoria. Then Westmead, 2145 in New South Wales, Melbourne, postcode 3000, Ipswich in Queensland, 4305, Mount Druitt in New South Wales, 2770, Ballarat, postcode 3350, Bellbird Park in Queensland, 4300, Camborne in New South Wales, 2570, and Southport, 4215 in Queensland. So that gives you a bit of a baseline view of where we are. Now, if you want to go into detail at a postcode level, then that'll be my live show in a couple of weeks' time. And in that show, what I'm going to do is to go into a granular analysis based on those postcodes that people want me to look at. So feel free to join that show if you'd like some more granular analysis. And in fact, if there's a particular postcode you'd like me to cover, drop it in the comments below and I'll pick it up and show it when I go through the show. Before I finish, I just want to cover off my scenarios because, of course, the scenarios drive the analysis. And essentially, the best scenario at the moment would be rate cuts in May and more later in the year. I've actually incorporated 4 cuts through this year. We see inflation easing in line with RBA expectations. We see wages rising faster than inflation in this scenario. We don't get a recession, and migration still remains above average. The baseline is a bit of a softer story where we have rates still at 4.1% until September 2025. Inflation falls but then sort of picks up again and stays above target until 2026. We don't get a recession. Australia migration falls to average. And the worst case scenario, the nightmare scenario, is we see rates staying at 4.1%. Inflation steps up, but unemployment rises, wages growth stalls, and That's really due to the second order trade-led recession in Australia. So rates fall later, migration drops below average. And of course, each of those scenarios, which are just examples of what could happen, can be plugged into the model. And when I plug them into the model, I then get some different outcomes. And those outcomes are quite interesting because it gives you some of the sensitivities that may be in the system. We'll start with Western Australia. And the story is that if we get the best scenario, there is still significant growth in the Western Australian market over the next 3 years, maybe 21%. Even the base case scenario still shows a small rise for houses, and it's only in the very worst case scenario where we get recession that prices ease back. Units tend to follow on pretty closely. If we turn to Queensland, it's a rather similar story. In the best case scenario, still significant rises ahead, maybe 19% over the next 3 years on average. This is a cumulative view. The baseline would be roughly sideways, and the worst case scenario would be a fall if things went pear-shaped, economically speaking, in Australia, and units would follow on. Looking at South Australia, it's a similar story. Again, strong growth, 20% over the next 3 years, best case scenario. The base case scenario would be a little bit over the next year and then relatively flat. The worst case would be a fall and units would follow on. In New South Wales, again, there is still a scenario where prices will rise over the next 3 years, maybe 13%. The baseline would be a fall, however, and the worst case scenario would be a more significant fall, and units would tend to follow on. In the ACT, again, the best case scenario would show further price rises. The base case, some falls, and the worst case would be a very significant fall. Units following on. In Tasmania, the growth is there, but perhaps not as strong as some other states. In the best case scenario, in the base case, there could be a fall, and in the worst case, a more significant fall. Units, again, mirroring quite closely what houses are doing with a slightly smaller fall. And in Victoria, there is still a scenario where prices will rise from this point, maybe 5% over 3 years. That's in the best case scenario. In the base case, there would be a bit of a fall, maybe 13% down over 3 years. The worst case, a more significant fall, and units again following on. For the Northern Territory, potentially a considerable rise, maybe 21% over 3 years. Baseline flat, and the worst case, a fall, units following on. But the measurements here are based on very low numbers of properties, so it's pretty volatile. Now, just before I go, just to remind you that there is a set of granularity that's available. Here's a sample of that. And you can see here that the analysis that we go through, as we will in a couple of weeks, goes into considerable detail with regards to disposable monthly income. For example, here in this postcode, it's 2500, which is Wollongong. 40% of the disposable monthly income for the household is going on a typical mortgage at more than $2,100. The rent is 32.9% at $1,993. So not only do you get the disposable monthly income, which is probably the most critical measure of what's going on, but you can see there that the mix of properties between houses and units, the gross investment yield and the net investment yield in this particular postcode, net investment yields are negative, so investors are losing money on cash flow basis. You can also see what the average taxable income is and whether multiple incomes are going on to pay the mortgage, like here. And we can also get the same view of where property prices are going. So this information is available for more than 2,000 postcodes across the country. It's updated every month. And if you want to grab that, you can do it via our Patreon program, as I'll discuss very shortly. Just before I finish, I want to make two other quick points. There is, of course, considerable pressure on households, and it's clear that quite often households need help. The worst thing to do is put your head in the sand and hope things will improve. in the current environment, that's relatively unlikely, even with the prospect potentially of rate cuts. So it is worth making a note of this National Debt Helpline number, 1-800-007-007. This is the government-backed debt counselling service. And if you have financial pressures and a lot of debt, they are worth talking to. And of course, you need to be careful. If you go on Google, then you can find people who will charge for advice when perhaps you don't need to pay for it and won't necessarily be able to provide the skilled service that the National Debt Helpline offers, although they are extremely busy at the moment. Another tool which I always refer to is AFCA's Statement of Financial Position, which is a downloadable form where you can put your own details, your household income, living expenses, details about the property, other assets, debts, and also what you think you can do with regard to managing your cash flow, because frankly, managing cash flow is critical at the moment, and prioritizing what's critical versus what's not as important. So that is a really useful tool, and I found a number of people have really benefited from filling it in. Of course, if you fill it in, you can then take it to your bank or use it with regard to having a conversation with a debt counsellor. Now, as I said earlier, the information is available via Patreon. If you're interested in grabbing the full data set, it comes out every month, and it will be sent out around the middle of the month after my show, where I've gone into the detail. You can subscribe. There are various levels via Patreon, but the $50 a month plus GST level gives you access to all the granularity. So you can do your own modeling. You can work out where the most stressed households are, where the gross and net investment yields are better for investment properties, and a whole bunch of other things too. And I'll just talk a little bit about the other information which is available. walktheworld.com.au is my home site, so check that out. And of course, my blog at digitalfinanceanalytics.com/blog, which contains all of the data from all of my posts and a lot of other background information too. And if you're interested in supporting what we do, always greatly appreciated. You can do that also via our PayPal. There's a link there. I do appreciate all those who support what we do, either via Super Chats or via our PayPal, or indeed via Bitcoin for those who want to use that particular method. So coming to the end of the show, it's worth just highlighting again that households are significantly under pressure at the moment. It's been building for some time. I don't think that the election is going to make a huge amount of difference. Both sides of politics are frankly playing with the prospects of helping, but the financial pressure on many households are considerable. If you haven't voted yet, it's worth making sure that you understand how the proportional voting system works, and it's worth understanding how preferences can be shifted around. And of course, it's important to perhaps recognise that the two big parties have actually failed most Australians in recent times because housing affordability is completely shot. Many households are under financial pressure, so maybe it's time for a change. Anyway, thank you very much for listening to this show, and I hope you found it useful and interesting. So a final reminder, my next live show, when I discuss mortgage stress at the postcode level, is on the 13th of May. And if you would like to have me look at a particular postcode, you can drop it in the chat below on this show, or indeed join the live show and ask for it live. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.